The yellow Rolls-Royce gleamed under the Manhattan sun. Jesse Livermore owned 6 of them. In the autumn of 1929, he was worth over $300 million in today's money. He had shorted the market at its peak, riding the collapse like a master surfer on a tsunami. But here's the paradox. Most of his fellow speculators, the ones who believed the party would never end, lost everything in a matter of days. They had confused a bubble for a revolution. They had mistaken leverage for genius. And they had ignored every warning sign that history was about to repeat itself. Now, nearly a century later, we stand at a similar precipice. The champagne is flowing again. The ticker symbols have changed. But the music sounds hauntingly familiar. The story begins not in 1929, but 5 years earlier, when America was emerging from a brief post-war recession into what would become known as the Roaring Twenties. Between 1924 and 1929, the Dow Jones Industrial Average didn't just grow, it tripled. This wasn't gradual prosperity. This was a vertical ascent that defied gravity and common sense. The American economy was experiencing genuine innovation. Automobiles were revolutionizing transportation. Radio was connecting the nation in real time. Electrification was transforming daily life. Ford Motor Company was churning out Model Ts on assembly lines that seemed like magic to a generation raised on horse-drawn carriages. RCA, the Radio Corporation of America, was the tech darling of its era, promising to bring entertainment and information into every American home. These were real companies solving real problems. But somewhere along the way, reality and fantasy began to blur. The mechanism of madness was deceptively simple. Brokerage houses offered something called buying on margin, a system where investors could purchase stocks by putting down as little as 10% of the actual price and borrowing the rest from their broker. Imagine walking into a casino where you can bet $100 with only 10 in your pocket and the house happily lends you the other 90. When the market is rising, this leverage turns modest gains into spectacular fortunes. A stock that rises 20% doesn't earn you 20%. It doubles your money because you only invested 10% to begin with. The system was intoxicating. School teachers, factory workers, and housewives were suddenly playing the market. They weren't analysing balance sheets or studying earnings reports. They were following tips from shoeshine boys and taxi drivers. The prevailing wisdom was breathtakingly simple. The market always goes up. This wasn't entirely irrational. The American economy had fundamentally transformed. Productivity was soaring. Corporate profits were real and growing. But markets have a peculiar psychology. They don't just reflect reality, they distort it. As more money poured in, valuations detached from underlying value. Companies that existed only on paper, with no products and no profits, saw their stock prices soar based on nothing more than momentum and narrative. The financial press celebrated every milestone. Newspapers ran daily updates as if reporting on a sports championship that America was winning. Anyone urging caution was dismissed as a pessimist who didn't understand the new era of permanent prosperity. The Federal Reserve watched this euphoria with growing concern. By 1928, the central bank recognized that the market had overheated dangerously. Credit was too easy. Speculation had replaced investment. Throughout 1928 and into 1929, the Fed began raising interest rates in an attempt to cool the frenzy. This was the equivalent of slowly turning down the music at a party where everyone is dancing on tables. The intention was to engineer a soft landing, to gently deflate the bubble before it burst catastrophically. But bubbles don't deflate gently. They don't gradually return to normal. They pop. October 1929 arrived like any other autumn. The leaves were changing. The market was still near its all-time highs. Then on October 24th, Black Thursday panic selling began. 5 days later came Black Tuesday, when the bottom fell out completely. 16 million shares traded hands in a single session, a record that spoke to absolute capitulation. Fortunes built over years evaporated in hours. But here's what most people misunderstand about the crash. It wasn't just a bad week for wealthy speculators. The real devastation unfolded over the next 3 years as the bubble's collapse metastasized into the Great Depression. Banks failed because they had lent money for stock speculation. Businesses closed because consumer demand collapsed. unemployment reached 25%. The Dow Jones, which had peaked at 381 points in September 1929, wouldn't return to that level until 1954, a full 25 years later. An entire generation's wealth was erased. Jesse Livermore, the man with 6 yellow Rolls-Royces, understood something fundamental about markets that his contemporaries had forgotten. Trees don't grow to the sky. Prices that rise parabolically must eventually return to Earth. He had studied market psychology and recognized the classic pattern of manias. When optimism becomes universal, when skepticism is ridiculed, when everyone from the elevator operator to the university professor is playing the market, the end is near. Livermore positioned himself accordingly, building massive short positions that would profit from the collapse. His timing was nearly perfect, but money didn't save him from the darkness that follows such triumphs. Years later, despite his wealth, he would take his own life in a Manhattan hotel, leaving behind a note that read, "My life has been a failure." Success in markets, it turns out, doesn't guarantee success in life. Fast forward to 2025, and the patterns are repeating with eerie precision. The Dow Jones has recently crossed 43,000 points, up dramatically from its pandemic lows. But more telling is the frenzy around artificial intelligence. AI is the radio of our generation, a genuinely transformative technology that is simultaneously overhyped beyond recognition. Companies that add AI to their business description see their stock prices surge, regardless of actual implementation or profitability. Massive investments are pouring into AI infrastructure, into startups that promise to revolutionize everything from healthcare to transportation. Some of these promises will materialize. Many won't. But the market isn't distinguishing between viable businesses and vaporware. It's rewarding narrative over numbers. The margin buying of the 1920s has evolved but not disappeared. Today it takes the form of leveraged ETFs, exchange-traded funds, that use derivatives to amplify returns by 2 or 3 times. When the market rises 1%, these instruments rise 2 or 3. When it falls, the losses are similarly multiplied. Retail investors, many of whom began trading during pandemic lockdowns using smartphone apps that gamify investing, are employing leverage without fully understanding the risks. Options trading has exploded. Zero-day to expiration contracts options that expire within hours have become a popular speculation vehicle. This isn't investing. It's casino capitalism dressed in technological clothing. The Federal Reserve faces the same dilemma it confronted in 1928. For years, interest rates were held near zero to support the economy through the pandemic. This flooded the system with cheap money that inevitably flowed into asset prices. Stocks, real estate, cryptocurrencies, everything inflated simultaneously. Now, as the Fed has raised rates to combat inflation, markets have gyrated violently. Each rate hike triggers debates about whether the central bank is engineering a recession. The so-called Fed put, the market's belief that the Federal Reserve will always step in to prevent major losses, has encouraged reckless risk-taking. Investors have come to believe that downside is limited because monetary authorities will never allow a true crash. This moral hazard is precisely what existed before 1929. There's a remarkable piece of market history that directly connects these two eras. Paul Tudor Jones, the legendary hedge fund manager, became famous for predicting and profiting from the 1987 stock market crash. How did he do it? He studied the charts from 1929. He noticed that the price patterns preceding the 1929 crash, the parabolic rise, the brief consolidation, the final euphoric spike were repeating themselves in 1987. The market had formed what technicians call a blow-off top, the same formation that preceded the Great Depression. Jones positioned his fund accordingly, shorting the market heavily just before Black Monday in October 1987, when the Dow fell 22% in a single session. His recognition that history rhymes, that market psychology follows predictable patterns, turned potential catastrophe into extraordinary profit. But here's what makes our current moment potentially more dangerous than either 1929 or 1987: the scale of interconnection. Financial markets today are global and instantaneous. High-frequency trading algorithms execute millions of transactions per second. Exchange-traded funds that track indexes must buy and sell mechanically, regardless of valuation. When panic selling begins, these automated systems amplify the movement. The circuit breakers and safeguards implemented after previous crashes may slow the decline, but they cannot prevent it. Moreover, household wealth is more concentrated in financial assets than ever before. Retirement accounts, pension funds, even college savings all are invested in markets that may be significantly overvalued. The potential for a crash to devastate not just speculators, but ordinary families is unprecedented. The parallels extend beyond markets into broader economic fragility. In the late 1920s, income inequality had reached extreme levels. The wealthiest 1% captured a massive share of national income while ordinary workers saw stagnant wages. Consumer debt was rising as people borrowed to maintain living standards. The agricultural sector was already in recession years before the crash. When the bubble burst, there was no cushion. Today, wealth concentration rivals the pre-depression era. Student debt, medical debt, and credit card debt have reached record levels. The middle class, despite stock market gains, feels economically insecure. Housing prices in major cities have detached from what average workers can afford. These are not conditions for sustainable prosperity. They are conditions for fragility. The AI boom, like the radio boom of the 1920s, is built on a foundation of genuine innovation, surrounded by a superstructure of speculation. Artificial intelligence will certainly transform many industries. Machine learning models are already revolutionizing drug discovery, improving logistics, and enabling new forms of creativity. But the market is pricing in not just success but perfection. It's assuming that every AI startup will become profitable, that existing tech giants will seamlessly monetize these capabilities, that no unexpected obstacles will emerge. History suggests this is naive. The internet revolution of the late 1990s was real. It genuinely changed how we live and work. But the dot-com bubble still burst catastrophically because investors confused a real trend with guaranteed returns. Pets.com and Webvan were going to revolutionize commerce. They didn't. They went bankrupt. Most AI companies will follow similar trajectories. There are, of course, differences between now and then. The Federal Reserve has more tools and more willingness to intervene. Deposit insurance prevents the kind of bank runs that devastated the 1930s. Automatic stabilizers like unemployment insurance cushion economic downturns. The global economy is larger and more diversified. These factors may prevent a repeat of the Great Depression's full horror. But they won't prevent a crash. They may limit the damage, but they cannot eliminate the fundamental reality. Assets that rise far above sustainable valuations must eventually correct. The only questions are when and how violently. What makes this particularly poignant is that we know the script. We have the historical precedents. We understand the psychology of bubbles, yet we seem constitutionally incapable of learning the lesson. Every generation believes their bubble is different, that this time the fundamentals support the valuations, that skeptics are simply failing to understand the new paradigm. In the 1920s, it was the permanent plateau of prosperity. In the 1990s, it was the new economy. Today, it's the AI revolution and the Fed put. The language changes. The rationalization evolves. The outcome remains depressingly consistent. The great tragedy of financial manias is that the warning signs are always visible in retrospect but invisible in the moment. Extreme valuations, universal optimism, leverage reaching dangerous levels, skeptics being dismissed as out of touch, these signals are flashing red right now. But pointing them out invites ridicule. The market is still rising, so bears look foolish. Those cautioning restraint are accused of missing the opportunity of a lifetime. This is precisely how it felt in 1928 and 1929. The critics were eventually vindicated, but only after immense destruction. Jesse Livermore's yellow Rolls-Royces are a fitting symbol for our age. They represented wealth divorced from wisdom, success measured purely in financial terms, the belief that being right about market direction is the same as understanding life's deeper meanings. Livermore died with money but without peace. Many who survive the next crash will face a similar reckoning. Not everyone will lose money, some will profit handsomely by positioning against the bubble. But an entire society organizing itself around asset price appreciation, where teachers and nurses feel like failures because they can't time the market, where housing is treated as a speculation vehicle rather than shelter, where retirement security depends on the whims of algorithmic trading, this is a civilization with distorted priorities. The question isn't whether markets will crash. They will. Markets always do. The question is what we learn from the crash and whether we'll build something more sustainable afterward. The 1929 collapse led to the New Deal, to financial regulation, to a recognition that unconstrained speculation destroys both wealth and social cohesion. Perhaps the next crash will trigger similar reforms, breaking up companies that are too big to fail, restricting leverage, aligning incentives so that short-term speculation doesn't dominate long-term investment. Or perhaps we'll simply inflate another bubble, having learned nothing except to hope we're not the ones holding the bag when the music stops. For now, the party continues. The champagne flows. The charts point upward. The television pundits celebrate new highs. And beneath it all, the same forces that toppled empires and impoverished millions are gathering momentum. We have seen this movie before. We know how it ends. But we seem determined to watch it again, convincing ourselves that this time will be different, even as history whispers that it never is.